So double entry system of accounting is a method, or it's a system, or it is a process of accounting, and this is based on an accounting concept that is called dual aspect concept of accounting. It is based on dual aspect concept of accounting. Now, what is dual aspect concept of accounting? That I am explaining first. Tanu? So dual aspect concept of accounting says that every accounting transaction has two aspects, that is two sides. For example, when a business purchases goods, the two aspects involved are purchases of goods, so whether we call it purchases or receipt of goods, and the other one is payment of money or increase in liability of the business if goods are purchased on credit. So here we have one aspect, that is one side, and here we have other aspect of the same transaction. Have you got this, Tanu, or not?
Yes, sir.
When a business purchases goods, I repeat, the one aspect that is involved is purchases or receipt of goods, and other is either payment of money if goods were purchased by paying money upfront, or if money is not paid, then increase in liability of the business as goods are purchased on credit. Sorry, if goods are purchased on credit. And the liabilities towards whom? Towards the supplier from whom we have purchased the goods on credit. So this is how two aspects are involved. Have you got this?
Yes, sir.
So in double entry system of accounting, both the aspects involved in an accounting transaction are recorded in books of accounts. This way, it is a complete system of accounting, that is, gives complete information about the accounting transactions recorded so. Have you got this, Tanu? In double entry system accounting, what do? Is that we record both the aspects of a transaction in our books of accounts. So this way, later when we refer to the transaction that we have already recorded, when we refer to a transaction, we get to know complete information about that transaction. For example, here if I just record this aspect in my books of accounts, that my business received money, and I do not record this aspect, then I will never get to know as why did I or how did I receive money. But if I record this aspect as well, then I will understand, okay, I received money from a bank towards whom now I am liable to repay that money. If I just record this aspect, that yes, I have a liability towards the bank, later I may not recall as why I have that liability if I do not record this aspect as well. That is receipt of money. Have you got me or not, Tanu?
Yes, sir.
Similarly, here for sale of goods,
Yes, sir.
so as I said that in every accounting transaction or in every accounting event, there are two aspects involved. In double entry system of accounting, we record both the aspects in our books of accounts. That is, we record both the sides in our books of accounts, and while doing so, we give sign of debit to one aspect and sign of credit to the other aspect. So which aspect is given sign of debit and which is given sign of credit? Like here, should I give sign of debit to this and sign of credit to this, or the other way around? To know this, one must know rules of accounting, and this is the core of accounting. If you do not know rules of accounting, you know nothing in accounting. And if you know rules of accounting, you know half of accounting. So this is how it is very important, guys. Rules of accounting. So rules of accounting, though I have already mentioned it here, tell us which aspect of an accounting transaction or accounting event should be given sign of debit and which should be given sign of credit. These rules can be understood under the following, through the following two approaches. So there are two different approaches to understand rules of accounting. Note down this much, Tanu.
Done, sir.
So one of the approaches is traditional approach. Now in accounts we have total 6 items. There are only 6 items in accounting, viz. Expenses, income, assets, liabilities. These four I have explained you in detail. And apart from these two, we have two more, losses and gains. Gains means profit. Though there is a little difference between profit and gain, but yeah, it is almost the same thing. So there are 6 items, Tanu: expenses, income, assets, liabilities, losses and gain. In traditional approach, these 6 items are classified under 3 groups. One of the groups is real accounts. This is name of a group. Now under real accounts, what do we have means what comes out of these 6 items under real accounts that I am explaining now. So it includes all those assets which are of physical nature and are present in the business physically in reality. It includes all those assets which are of physical nature and are present in the business physically in reality. That is fixed assets, all fixed assets, whether tangible or intangible. So all fixed assets, whether it is plant and machinery, land and building, furniture, vehicles, patent, copyright, they are of physical nature and they are present in the business physically. Then stock, that is unsold goods, and one more item, that is cash in hand, that is cash available with the business in its cash drawer or in its cash safe. So there are only 3 items which are part of real accounts. Have you got this?
Yes, sir.
So what you people should keep in mind is that real accounts includes only assets, but not all the assets. It includes only those assets which are there in physical form and which are present in the business physically. Like cash at bank means cash deposited by a business in bank with the bank. That is also asset of the business. That is not available with the business physically. It is with the bank, not with the business. That is why cash at bank, though it is an asset, but it is not part of real accounts. Have you understood this?
Yes, sir.
Margi, have you understood this?
Yes, sir.
Next thing that we'll see is rules of accounting for real accounts, but this we will see too. Tanu, please note this down fast. Have you noted down this much? Traditional approach?